The Philippines joined the world's 20 biggest economies due to its large population and fast-improving industries.
The Philippines became Southeast Asia's fastest-growing economy.
At first glance, Southeast Asia looks like a familiar economic landscape. Thailand, long regarded as a regional anchor with mature tourism, deep manufacturing, and broad export networks. And the Philippines, a younger, faster-growing economy, still building out its industrial capacity. But the numbers emerging from 2024 to 2026 tell a different story. Across the region, analysts have begun noticing a subtle but decisive shift. The Philippines is now outpacing Thailand in economic momentum, and in several key indicators, it has already pulled ahead. Whether you look at GDP growth projections, tourism's share of national output, or the direction of foreign investment, the Philippine economy is gaining speed at a time when its neighbor is struggling to recover its pre-pandemic trajectory. In tourism impact, for example, the Philippines posted an estimated $91.8 billion contribution to GDP in 2024, accounting for 19.9% of national output, compared with Thailand's $67.3 billion at only 12.8% of GDP, a surprising reversal in regional perception and a strong signal of the Philippines' rising services strength. On the growth front, institutions like the Asian Development Bank forecast the Philippines expanding at 5.6% in 2025 and 5.7% in 2026, keeping it among Southeast Asia's top performers. Thailand, by contrast, is projected to grow by only approximately 2.0% in 2025 and 1.6% in 2026, weighed down by slower exports, weak investment, and a muted tourism rebound. And while both countries face global trade uncertainty, the Philippines' consumption-driven structure gives it a resilience Thailand no longer enjoys at the same scale. As the IMF and World Bank note, private consumption, easing inflation, and a young labor force continue to anchor Philippine expansion even when exports soften. So the real question isn't whether the Philippines is richer yet. It's not. The real question is, how did the Philippines become Southeast Asia's next big economy? And why is its momentum now overtaking Thailand's? That's the story we're breaking down today. To understand why the Philippines is gaining ground, start with trajectory, not baseline. Thailand still has the higher GDP per capita, about 7,900 to 8,100 versus roughly 4,600 to 4,700 for the Philippines on recent IMF projections. But growth rates diverge sharply. The Philippines is expanding around 5 to 6% annually, while Thailand is closer to 1 to 2%. Over a decade, that difference compounds into a widening performance gap, even if Thailand remains wealthier per person. Tourism highlights the shift. Thailand still draws more visitors, yet tourism now contributes a larger share of Philippine GDP, close to 1/5 of output, showing how travel, hospitality, and transport anchor domestic activity. Thailand's tourism share is lower because its economy leans more on manufacturing and exports, sectors that have recovered more slowly. Forecasts reinforce the divergence. The Asian Development Bank expects Philippine growth around 5.6% in 2025 and 5.7% in 2026, supported by consumption and public investment. Thailand's outlook sits nearer 2.0% in 2025 and 1.6% in 2026, reflecting weaker exports and slower tourism momentum. Domestic demand is the Philippines' main buffer. About 70% of GDP comes from consumption, backed by remittances and a relatively strong labor market, which helps offset global trade swings. Thailand faces tighter credit and high household debt, limiting consumer recovery. Demographics deepen the contrast. The Philippines has a median age near 26 to 27, sustaining workforce and consumption growth. Thailand is aging faster, which constrains long-term expansion. Investment trends add nuance. While Philippine FDI softened in 2025, earlier inflows were strong and interest remains in manufacturing, services, real estate, and renewables. The country is increasingly positioned as a China Plus One destination for firms diversifying supply chains. Thailand still benefits from established industry, but faces headwinds from softer exports, tourism competition, and high private debt. The overall picture: Thailand remains stable and wealthier per capita, but the Philippines is growing faster. In Southeast Asia's growth race, momentum matters, and right now, the Philippines has it. Overtaking isn't about today's size, it's about the path investors are pricing. Thailand still has higher income per capita and a larger economy by some measures, but growth trajectories diverge. Major forecasts for 2025 to 2026 place Philippine expansion around 5 to 6% annually versus roughly 1.6 to 2.4% for Thailand. Over several years, that compounding gap shifts where capital expects stronger returns, which is why many analysts now frame the Philippines as a regional growth bright spot. Tourism shows the difference between volume and impact. Thailand still earns more from visitors overall, but tourism accounts for a larger share of Philippine GDP, close to 1/5, because services play a heavier role in its economy. Thailand's broader, export-oriented base dilutes tourism's proportional share, even when arrivals are high. The Philippines also benefits from a services buffer. Consumption and services, especially business process outsourcing, finance, and digital platforms, drive most output, cushioning the economy when global trade slows. That helps explain why forecasts remain in the mid-5% range despite external risks. Thailand, more tied to manufacturing cycles and merchandise exports, has faced softer demand and tighter credit conditions. Demographics reinforce the divergence. A median age, near 26 to 27, supports workforce growth, housing demand, and consumer spending in the Philippines. Thailand's older population and higher household debt constrain consumption rebounds. Foreign investment adds context. Philippine inflows fluctuated in 2025, but medium-term interest remains strong in renewables, data centers, services, and select manufacturing, supported by market-opening reforms. Thailand retains deep industrial capacity, yet its near-term challenge is slower growth momentum. The takeaway: Thailand remains stable and wealthier per capita, but the Philippines currently has the stronger growth velocity. That momentum, more than present size, is what investors mean when they talk about overtaking. Two economic dashboards sit side by side. On Thailand's, tourism and export gauges flicker but rarely surge. Credit conditions stay tight and growth hovers in the low twos. On the Philippines display, domestic demand runs steadily, services exports hold, inflation drifts into target, and the central bank eases just enough to keep expansion in the mid-5% range despite global trade friction. Momentum shifts not in a single jump, but frame by frame. Zoom in to the human layer. A traveler chooses Cebu over Phuket for value and variety. A young coder returns from overseas to work hybrid for a fintech linked to the BPO sector in Bonifacio Global City. These micro-decisions accumulate. Tourism's economic footprint grows, services employment expands, and consumption multipliers strengthen in the Philippines. Thailand still draws more visitors overall, but uneven arrivals and cost concerns temper its tourism rebound. Same region, different speeds. When tariffs and trade uncertainty ripple through ASEAN, the contrast sharpens. Thailand's export-heavy model feels the drag more directly. The Philippines takes a hit in goods, but its services engine, outsourcing, shared services, digital work, absorbs part of the shock. Forecasts trim both economies, yet the Philippines keeps a growth premium into 2026. Demographics reinforce the divergence. With a median age in the mid-20s, the Philippines adds workers and consumers each year, feeding demand for housing, data, finance, and transport. Thailand's older population and higher household debt make consumption harder to accelerate without stimulus. The Philippine internal market feels younger, louder, and more self-propelling. Policy notes from institutions like the World Bank and the International Monetary Fund stress that risks remain: governance, climate exposure, external trade swings. But reforms and steady execution could unlock upside. Thailand, for its part, still has deep industrial strength and showed late 2025 acceleration, proving it can rebound when conditions align. Yet near-term forecasts remain modest, and the challenge is restoring growth velocity. The reveal isn't that one economy has surpassed the other on every metric. It's that investors now watch where growth will compound fastest over the next decade. On that trajectory, the Philippines increasingly screens as a regional leader alongside other high-momentum Southeast Asian markets, an overtake defined less by current size than by future pace. In my perspective, the Philippines' edge isn't a one-off surprise. It's the product of three reinforcing dynamics. 1. A demographic dividend that fuels consumption and labor supply. 2. A services-heavy growth model that cushions trade shocks. And 3. Policy space created by disinflation that lets the central bank support activity without stoking price spirals. Put differently, demand, design, and discipline. And Thailand's current cycle is struggling on at least two of those three. Demand. With a median age around 26 to 27, the Philippines is early in the household formation curve. That matters for everything from telecom ARPUs and logistics to grocery, housing upgrades, and financial penetration. Younger cohorts also mean more flexible labor, which helps services scale faster. Thailand's older profile and high household debt mute the same rebound in private consumption, keeping the growth impulse weaker even when tourism improves. Design. The Philippine economy is consumption-led and services-intensive. That's exactly the configuration you want when goods exports face tariffs or soft global demand. It's why multilateral forecasts cut growth only to the mid-fives, not because the external drag is small, but because the services buffer and domestic demand carry the cycle. In parallel, the flexibility to ease policy rates as inflation cooled helped prevent a deeper slowdown. Thailand, more connected to manufacturing cycles and with constrained credit, felt the drag more acutely through 2025. Discipline. None of this is guaranteed. The IMF and World Bank both flagged governance and execution risks for the Philippines. Delays in public investment, confidence hits from scandals, and climate vulnerability. But they also underlined that faster reform implementation could unlock upside above baseline growth. That's the essence of my stance. The Philippines has earned a growth premium, and it keeps it if execution stays on track. For Thailand, the playbook is different. The country retains deep supply chains, high-quality tourism assets, and strong external buffers. But the priority is to raise velocity, unlock investment, alleviate credit constraints, and accelerate structural reforms to reignite productivity. The IMF's 2026 baseline near approximately 1.6% is not destiny. It's a warning that the next leg up takes policy follow-through. So, does the Philippines overtake Thailand? On momentum, yes. On income levels, no, not yet. But in boardrooms and fund memos, momentum is often what decides where the next marginal dollar goes. In that race, the Philippines is running downhill with the wind at its back. The story to watch isn't just the size of each economy, it's the growth spread between them. Most baseline forecasts keep the Philippines expanding in the mid-5% range through 2026, while Thailand sits closer to the low 2s or high 1s. That gap shapes where companies place new factories or offices, how investors allocate capital, and which labor markets are hiring fastest. It could narrow if Thailand gets a strong policy boost or if Philippine execution falters. But for now, the spread is the signal. Look beyond factories to services. The Philippines engine, IT BPO, fintech, shared services, data centers, and tourism-adjacent sectors, offers both cyclical resilience and long-term expansion. Even when monthly foreign investment data turned uneven in 2025, multinational firms kept the country on shortlists for diversification strategies. Growth in renewables and digital infrastructure reinforces that direction. Demographics continue to tilt the field. A young Philippine population sustains demand for consumer goods, housing, connectivity, and entry-level financial services. Thailand's older demographic profile means productivity-boosting reforms and targeted stimulus matter more for maintaining growth. Monetary policy is an early warning system. The Bangko Sentral ng Pilipinas had room to ease as inflation cooled, helping cushion growth. If inflation stays contained and projects move forward, the Philippines keeps its growth premium. Supply shocks or delays could narrow it. Tourism headlines also need context. A larger tourism share of Philippine GDP reflects how central travel and services have become to its economy, not that it earns more total tourism revenue than Thailand. Thailand still attracts more visitors overall, but uneven arrivals and perception issues slowed its rebound in 2025. For airlines, hotels, and local businesses, those distinctions matter. Bottom line, if you're allocating capital, building a regional sales plan, or hiring, price in a Philippine growth premium, but stress test execution risks. For Thailand, position for recovery optionality. When tourism normalizes and reforms stick, the snapback can be sharp, as late 2025 data already hinted. The region isn't standing still. Vietnam continues to lead on speed, Indonesia on scale, and Singapore on sophistication. But if you're asking where unexpected upside can still emerge, the Philippines now sits near the top of that list. Young, services heavy, and finally finding policy rhythm. None of this erases Thailand's structural strengths, but it does shift where growth is being priced right now. I'll keep tracking 3 things for you: growth spread, policy execution, and tourism and services mix. When those lines move, I'll break down what it means, clearly, and with the same focus on context over noise. If you found this useful, share your on-the-ground insights in the comments, especially if you work in tourism, BPO/IT BPM, logistics, or energy in either country. Your perspective helps sharpen this analysis for everyone. Thanks for watching.